Today I want to follow up on my video where I talked about how the Bitcoin bubble will pop. A lot of you were frustrated due to that title for obvious reasons, so today we are going to revisit the subject and discuss whether or not Bitcoin is, in fact, a bubble. Despite the parabolic growth and excitement that investors have, when you look at Bitcoin in the context of other asset classes such as stocks, bonds, and real estate, the price movement feels a little less unique. All of these more traditional asset classes are expensive relative to history. Even alternative investments in private equity are doing quite well. In this context, it is difficult to say definitively that Bitcoin is a bubble, although you certainly could argue that there is a rational exuberance. I would not disagree with that at all. Let's get started off with stocks. For those of you unfamiliar, there is a ratio many economists refer to as the Shiller PE ratio, and they use it to value the S&P 500. It essentially smooths earnings over time rather than using earnings from one specific year. And if you don't come from finance, this probably all sounds like Greek to you, and you likely only know Robert Shiller as the guy who recently called Bitcoin a fad, along with gold. But you should know that he predicted the last two bubbles, and he's the creator of the metric, building off of the work of Benjamin Graham and David Dodd. We are coming from people that are very well respected, and if we look at this metric, you will see that there's only been 2 points at which we have seen it at the level it's currently at, and that is right before the Great Depression and right before the dot-com bubble popped. So you might imagine many people are worried as a result of this. However, it isn't just the US where stock valuations are high. If you look at the graph here, you can see that any area in red is expensive relative to history. And I would encourage you guys to play around with this tool. I have provided a link for it in the article that corresponds with this video. Wealth managers, as a result of the expensive equities worldwide, have sort of started recommending previously underperforming emerging markets, as well as some of the internationally developed equities. In addition, if we look at the future forecast for stock returns, you will see that they are pathetically low. And so, when we look at the past decade or so, really all stocks of all sizes have performed quite well, right? And it's because of this fact that we are starting to see people hesitant moving into the future. There's also plenty of examples of stocks that have skyrocketed in this bull market, such as Nvidia and the FANG stocks. And if you're not familiar with what the FANG stocks are, that is Facebook, Amazon, Netflix, and Google. Now, technology companies as a whole have contributed significantly to the increase in valuation of the stock market. In other words, they have contributed to the increase in the PE ratio. And if you're not familiar with what the PE ratio is, just consider it the price of the stock market. That's the easiest way to think about it. The higher it is, the more expensive it is. More and more companies are being valued based off of their future potential rather than their current balance sheet and earnings, such as Tesla. And if you come from finance, you know that future potential is basically future cash flows discounted back to today. You know about the time value of money. Well, we have to discount those cash flows in the future, and we are using lower and lower discount rates because investors have lower required returns, which is the result of loose monetary policy causing lower interest rates. I know that was a mouthful, but the gist of it all is that because we have lower interest rates, investors require lower returns, which means that future cash flows are worth more today than they were, say, 5 to 10 years ago. Actually, that's not true. Not 5 years ago, but if we look 10 years ago, then they are. Because earnings are still strong, people are struggling to dismiss equities, and this has driven them higher and higher. The availability of cheap capital has allowed many firms to expand inexpensively, such as the Brookfield family, as I call them. They focus mostly on hard asset projects such as infrastructure and renewable energy, and have access to cheap capital from Brookfield Asset Management. Due to this, they have generated sizable returns for investors over the past year or so. So this is an example of a company that's taking advantage of the cheap capital situation, increasing their earnings. All of this is to say we have rich equity valuations, but wealth managers are still finding reasons to invest in the markets right now. And you'll hear that all the time on CNBC. Yes, we have rich equity valuations, but I'm not seeing a reason not to invest in the markets. You'll hear that statement over and over and over again. Many of these same wealth managers, driven by comparisons to the dot-com bubble, speculate that Bitcoin and other cryptocurrencies are nothing but a bubble themselves. Some even believe it will go to zero. While I'm fine with arguing that Bitcoin is overpriced, you should not dismiss cryptocurrencies just because of this. Imagine economists in the late 1990s who dismissed the internet because it only consisted 1% of online sales. Now think about how the story has completely reversed and everybody is talking about retailers going out of business as a result of the Amazon effect, right? So you are fine to say that it's overpriced, but I would not dismiss it as a result of that, just as you shouldn't have dismissed the internet. I'm willing to concede that there has been a ton of speculative market behavior. In addition, the booming ICO market, we've talked about this before on this channel, where investors are essentially blindly throwing money at any project that sounds like a good idea. It doesn't even have to be a product at this point. As long as it sounds good, people throw money at it. And that obviously isn't helping the image for Bitcoin. In addition, there is a $1.4 billion Ponzi scheme just literally hanging out in the top 10 cryptocurrencies. And so, despite this, there are several differences between Bitcoin and the dot-com bubble. First of all, traditional investors haven't even started to touch Bitcoin. The only traditional way to invest in Bitcoin is through the Bitcoin Investment Trust, and that isn't even ideal because of the share creation process being limited to accredited investors and then time-locked. Bitcoin ETFs should lead to a huge flow of new capital into the market, and approval odds for an ETF should improve as the Bitcoin derivatives market grows in 2018. In addition, dot-com companies simply did not have sustainable business models, right? If you think about it, they had much lower revenues than their expenses. They kept investing more and more into marketing as well as R&D. And as a result of that, they made up metrics such as website visitors to ignore profits. As a result of that, they also avoid balance sheets because they could just simply raise more capital in the frothy private and public markets. Bitcoin, on the other hand, is really a labor of love if you think about it, right? Bitcoin Core and the variety of other developers that work on Bitcoin, they would basically do it for free. And the marketing for Bitcoin is all grassroots as well. In other words, it is free. Unlike, say, Pets.com, which spent $12 million to get just $600,000 worth of revenue. Now, cryptocurrencies are also peanuts in comparison to the NASDAQ, having topped at only $170 billion compared to the NASDAQ back in 2000, which reached $4 trillion if I recall correctly, maybe even higher. The reason why pulls from fact number one that I just pointed out here, which is that traditional investors don't know how to invest in Bitcoin. They know how to invest in stocks, but they do not know how to invest in Bitcoin. How many of them do you think know what a hardware wallet is? How many do you think know the difference between hot and cold storage? And forget it if you ask them what the most reliable exchanges are. Many of them still do their trades on the phone. We also have never experienced an asset class like cryptocurrencies before. Like a currency, Bitcoin can be used as a unit of account and store of value, but struggles to be used as a medium of exchange due to its volatility. It also isn't backed by any government, something many of us here like. Its price is determined by supply and demand like a commodity, yet it also offers a service similar to how a company would. Yet, unlike a company, it generates no cash flows. So what can we really call it? Well, according to Chris Berninski, it's a crypto asset. Go read his new book, seriously. I'm not even selling out here, he's not promoting it or any way. It's just a phenomenal resource that I encourage anybody to look into. Lastly, aside from cryptocurrency enthusiasts, very few people are talking about how this new asset class is going to cause a new economy where productivity will increase for eternity as they were in the 1990s. That was the thought process back then. GDP could go into infinity and never recede because of the fact that productivity was going to continue going up and up and up as a result of the internet. Now, aside from a few of you, there really isn't a ton of discussion on how Bitcoin will change the relationships between GDP, interest rates, unemployment, inflation, and credit cycles. Instead, all of that discussion is being reserved for loose monetary policies such as quantitative easing and zero interest rate policy. And so even the people who don't agree with Bitcoin many of them are still discussing this concept of loose monetary policy. And this is exactly what many cryptocurrency investors are aiming to avoid. Now, I know that there's a group who believe that cryptocurrencies will ultimately replace fiat currencies in the long term, yet realistically, I doubt many of them would bet on that viewpoint during their lifetime. Maybe 100, 200 years from now, but if you force somebody to bet in the next 10 years or so that fiat currencies are going to be replaced, I guarantee you they would not put their money where their mouth is. He's a crazy bastard. You can't predict him. In summary, while we do have irrational exuberance as we did in the 1990s, at least I believe we do, historical events do not literally repeat themselves to the last detail, as many people on CNBC might lead you to believe. There are some sizable differences between cryptocurrencies and the dot-com bubble that I hope you will consider fairly. Let's move into talking about other asset classes to gain a global perspective and hopefully provide some insights on why Bitcoin is generating its gains. For those of you unfamiliar, there is an inverse relationship between interest rates and bond prices. As such, bond prices have soared recently due to zero interest rate policies that we have seen worldwide. These policies have led to many asset managers forecasting that the next 30 years will be dominated by lower interest rates as well. However, it isn't just lower long-term interest rates that we are seeing. Just a quick rundown for anybody unfamiliar. A spread is the difference between the yield of a particular bond and the yield of a similarly matured treasury bond. It's essentially the compensation you receive for taking on greater risk, given that treasuries are considered to be practically risk-free. Now, I know many of you don't believe that, but that's how they're considered to be. These spreads have fallen significantly, which means riskier bond prices have soared as investors are hungrier for higher yields. Distressed and private debt have also become lucrative markets, as evident by Oaktree's excellent past year, and these are even riskier debt sources. As with equities, loose monetary policy has led to odd market conditions and a rather bubbly bond market. You'll note this is a common thread among all asset classes. Now, moving into real estate, I know we're just jumping all over the place here. The median home value in the US is up to $202,000 according to Zillow. We are back to where we were before 2008 in nominal terms across most areas. And for those of you unfamiliar with what nominal means, it just simply means with inflation, right? In other words, inflation is factored in, so the real value might be lower, right? Real is without inflation if we factor inflation out. The increase in home values isn't exclusive to the US, however. Developed nations have seen housing prices increase in real terms steadily over the past 5 years. This report only goes to Q1 2017, and at that point, real home values were 2% below what they were prior to the crisis. Given the continued strength of the housing market, real home values are now close to where they were prior to the housing bubble. Amazing, right? Some countries such as Canada, China, and Australia have seen explosive growth in property values. Now, real estate is one of the first asset classes unsophisticated investors flock to when prices keep going up. And the 2008 bubble is a perfect example of that. Or I guess you really should say the 2007 bubble. You've heard the stories. Those stock things are for wealthy people. But real estate? I have a friend who has a friend who flips houses for a living. My sister's husband rents out his second home and also makes money from the increase in the house value. How difficult can it be? It's like the gateway drug for investing, which is funny when you consider just how much more difficult it is to invest in than other asset classes. In addition, and this is a scary fact, mortgages are starting to become easier to secure again. I'm sure that doesn't surprise anybody though. And yet again, loose monetary policy and low interest rates have pressured consumers into purchasing a house now so that they can lock in the lower rate. In fact, I have a friend who just did that recently. Now, even if we move into alternative assets such as domain names, we've seen growth there as well. From Q3 2016 to Q2 2017, we have seen liquid domain names increase by 4.3%. And now, I know that sounds pathetically low compared to what you would get in almost any other asset class, but you have to be mindful of the fact that they're not cash-producing assets, and there is way more supply than there could ever possibly be true demand. And I can tell you anecdotally that when we look at domain names, the ability or the availability of cheap domain names relative to their true value it's tougher and tougher to find an underpriced domain. And you can ask anybody in the domain industry and they will tell you the same way. I suspect we will see a continued trend towards non-traditional assets moving forward as forecasted returns in traditional asset classes are so low. And I'm sure you can guess which one Bitcoin is. In the end, no one can say for certain whether or not Bitcoin is a bubble. We can infer that loose monetary policy has led to rich valuations across all asset classes. We also know that investors have been hungrier for higher yields and returns, pushing more capital into tech companies and riskier bonds, despite the fact that confidence in the markets are relatively low. It's like we're in a bull market because Mr. Market is being held at gunpoint by central bankers. Actually, that would make quite a good comic strip when you think about it, although it's probably been done already. Almost everything has. The gun is monetary policy, by the way, in case that wasn't abundantly clear. Bitcoin is an asset that has not only offered returns, but is also the first killer app of a brand new powerful technology known as the public blockchain. And I really want to emphasize the word public in this context. We are only beginning to explore the implications of this technology, but we know that Bitcoin's sheer size makes it very difficult for other cryptocurrencies to displace it in its niche case of peer-to-peer transactions. Due to its decentralized nature, Bitcoin has begun to act as a safe haven asset for countries who face hyperinflation such as Venezuela. We've also seen it move the same direction as gold during the last two North Korean threats. Even disregarding its hedges against geopolitical instability, Bitcoin has a notably low correlation against other asset classes. Several studies have shown that Bitcoin's correlation with stock markets, bonds, and commodities such as gold are close to zero. And the primary reason behind that is volatility, as you might expect, which in turn is the result of the fact that Bitcoin is pitiful in size relative to the other asset classes we're comparing it to. And we're starting to see financial advisors look at the place of cryptocurrencies, such as Bitcoin, in a modern portfolio due to the low correlations that we're seeing. Now, the largest catalyst on the horizon for Bitcoin is the approval of a Bitcoin ETF, which will allow traditional investors to enter the market more easily. Note that the only traditional vehicle right now, the Bitcoin Investment Trust, trades at a sizable premium because of investor demand. Now, some of this demand comes from the fact that it is the only vehicle that investors can use to have exposure to Bitcoin in an IRA. However, there are other options out there, such as a self-directed IRA, which you can set up with Bitcoin IRA. That's literally the name of the company. Now, the premium behind GBTC, in my opinion, can only be explained as the byproduct of, number one, traditional investors honestly have no clue on how to invest in the underlying asset, and number two, the share creation process means that there is limited supply, but an increasing demand as we see Bitcoin demand increase, right? The point of all of this, in case you've felt a little bit lost over the last few minutes here, is that investors are waiting on the sidelines to get into Bitcoin. The last crash was eaten up very quickly at $3,000, which would have been considered a remarkable price level just 3 months ago in July. I can't tell you whether or not Bitcoin is a bubble definitively. Nobody can tell you that. But I can tell you that there is no shortage of investors in the markets for riskier assets. And that's regardless of what anybody tries to tell you on CNBC. I can also tell you that it is an infant in relation to the other asset classes that we're comparing it to, which makes some of those comparisons a little bit invalid, right? Such as comparing Bitcoin to the NASDAQ back in 2000. As institutional investors start to jump in, more businesses will as well. While the name of Bitcoin has sort of spread across Wall Street, it is still a long way to go before it gets into the households of mom and pa, just like email was back in the 1990s. And many of the investors you see today are betting that we will reach that point. And what's funny to me is that many of the people who talk about Bitcoin being overvalued have no means by which to value the damn thing in the first place. How can you say that it's overvalued or overpriced or in a bubble unless you're just talking about behavioral finance? And that's the truth of the matter here, is that everybody's talking about behavioral finance when they talk about the overvaluation of Bitcoin. And I would say that loose monetary policy has led to the inflated values that we see across all asset classes. And that, as a result, has led to cash flows coming into Bitcoin. So it's hard to say whether or not Bitcoin itself is uniquely a bubble, or if all risky markets have actually been bloated in value as a result of central bank policy. We've seen this with alternative investments surging in popularity as investors try to escape the low forecasted returns for traditional assets. And so it all really comes down to a matter of opinion. Very few people are offering models by which we can say Bitcoin is worth this price or this price. And those that are offering models, they're usually fairly weak, right? And so in the end here, it's anybody's guess, right? But I will say this much. There is a ton of evidence to suggest in both directions that Bitcoin is a bubble and that it's not a bubble. Because when we look at asset classes globally, you really can argue both ways. And I hope you give it a fair thought regardless of where you come from. If you come from finance, I hope you give it fair thought to the idea that it's not a bubble. And if you come from cryptocurrencies, I hope you give it a fair thought to the idea that there is a rational exuberance and therefore it could be a bubble. As usual, I hope you all enjoyed the video. Leave a like, comment, and subscription, and I will get back to you as soon as possible. Thank you for watching.